When it comes to investing, many people immediately think of the stock market. However, there is a wide range of other investment options available that can help diversify a portfolio and potentially provide steady returns. A bond is essentially a loan that an investor makes to a borrower, typically a government entity or a corporation. When an investor purchases a bond, they are agreeing to lend money to the issuer for a specified period, known as the maturity date. In return, the issuer agrees to pay the investor regular interest payments, called coupon payments, and to return the face value of the bond upon maturity. There are several types of bonds, each with its own characteristics and risk profile. Government bonds, also known as treasury bonds, are issued by national governments and are generally considered to be one of the safest investments, as they are backed by the full faith and credit of the issuing government. Corporate bonds are issued by companies and tend to offer higher interest rates than government bonds, but they also carry more risk, as the company could default on its payments. Municipal bonds are issued by state and local governments to fund public projects and are often exempt from federal taxes. The interest rate on a bond is determined by several factors, including the creditworthiness of the issuer, the length of the maturity period, and prevailing market interest rates. Bonds with longer maturity dates generally offer higher interest rates to compensate investors for tying up their money for a more extended period. Credit ratings, assigned by agencies like Moody's and Standard and Poor's, provide an assessment of the issuer's ability to repay the bond and can also affect the interest rate. Investing in bonds offers several advantages. They provide a predictable stream of income through regular coupon payments, and they tend to be less volatile than stocks, offering stability to a portfolio. Bonds also offer the potential for capital appreciation if interest rates fall, as the value of existing bonds with higher interest rates will increase. However, there are also risks associated with bond investing. If interest rates rise, the value of existing bonds will decrease. Additionally, there is always the risk that the issuer could default on the bond, resulting in a loss of principal for the investor. A mutual fund is an investment vehicle that pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Mutual funds are managed by professional fund managers who make investment decisions on behalf of the fund's investors. By investing in a mutual fund, individual investors can gain exposure to a wide range of securities without having to purchase each one individually. There are many different types of mutual funds, each with its own investment strategy and focus. Stock funds invest primarily in stocks and can be further categorized by the size of the companies they invest in, large cap, mid cap, or small cap, the style of investing, growth or value, or the geographic region, domestic or international. Bond funds invest primarily in bonds and can be categorized by the type of bonds they hold, government, corporate, or municipal, or the maturity length, short term, intermediate term, or long term. Index funds aim to replicate the performance of a specific market index, such as the S&P 500, by holding the same securities in the same proportions as the index. Sector funds focus on specific industries such as technology, healthcare, or energy. Mutual funds offer several advantages to investors. They provide professional management, as the fund managers are responsible for researching and selecting the securities in the fund's portfolio. They also offer diversification, as each fund typically holds a large number of securities, spreading the risk across many different investments. Mutual funds also offer liquidity, as investors can easily buy or sell shares of the fund at any time. However, mutual funds also have some disadvantages. They charge fees, known as expense ratios, which can eat into returns over time. They also lack the flexibility of individual stock or bond investing, as investors have no control over the specific securities held in the fund. An annuity is an insurance product that provides regular payments to an investor, either immediately or at some point in the future. Annuities are often used as a retirement income tool, as they can provide a guaranteed stream of income for the rest of the investor's life. There are several types of annuities, each with its own features and benefits. Fixed annuities offer a guaranteed fixed interest rate and fixed payments, providing predictability and stability. Variable annuities offer the potential for higher returns by investing the funds in a portfolio of mutual funds, but the payments can fluctuate based on the performance of the underlying investments. Indexed annuities offer a return that is based on the performance of a specified market index, such as the S&P 500, with a guaranteed minimum return. One of the main advantages of annuities is the potential for tax-deferred growth. The money invested in an annuity grows tax-free until it is withdrawn, allowing for faster accumulation of wealth. Annuities also offer the benefit of guaranteed income, which can provide peace of mind in retirement. However, annuities also have some drawbacks. They often come with high fees, including surrender charges if the money is withdrawn early. They also lack liquidity, as the funds are typically locked up for a specified period. Additionally, the guaranteed income from an annuity may not keep pace with inflation over time. When considering an investment in a mutual fund or annuity, it is essential to review the prospectus. A prospectus is a legal document that provides detailed information about the investment, including its objectives, risks, fees, and past performance. The prospectus is designed to help investors make informed decisions about whether the investment is suitable for their needs and goals. Real estate is another popular investment option that can provide both income and capital appreciation. There are several ways to invest in real estate, each with its own advantages and disadvantages. Direct ownership involves purchasing a property outright and either living in it, renting it out, or selling it for a profit. This approach offers the most control over the investment, but also requires a significant amount of capital and hands-on management. Real estate investment trusts, REITs, are companies that own and manage income-generating real estate properties. Investors can purchase shares in a REIT, providing exposure to the real estate market without the need to own and manage properties directly. REITs are required to pay out 90% of their taxable income to shareholders in the form of dividends, making them an attractive option for income-seeking investors. Real estate funds, such as mutual funds or exchange-traded funds, ETFs, provide exposure to a diversified portfolio of real estate investments. These funds can invest in REITs, real estate companies, or direct property holdings. Investing in real estate offers several potential benefits. Real estate can provide a steady stream of rental income, as well as the potential for capital appreciation over time. Real estate also offers diversification benefits, as it tends to have a low correlation with other asset classes like stocks and bonds. However, real estate investing also comes with risks. Property values can fluctuate based on local market conditions, and owning direct property requires significant upfront capital and ongoing management responsibilities. Commodities are physical goods that are interchangeable with other goods of the same type. Examples include precious metals like gold and silver, energy products like oil and gas, and agricultural products like corn and wheat. Investors can gain exposure to commodities in several ways. Futures contracts are agreements to buy or sell a specific quantity of a commodity at a predetermined price on a future date. Investors can use futures to speculate on the price movement of a commodity or to hedge against price risk. Commodity ETFs provide exposure to a single commodity or a basket of commodities by holding futures contracts or physical commodities. These ETFs trade on stock exchanges and can be bought and sold like stocks. Investors can also gain exposure to commodities through physical ownership, such as holding gold bullion or collectible coins. However, physical ownership requires secure storage and can be less liquid than other investment options. Investing in commodities offers the potential for portfolio diversification, as commodities tend to have a low correlation with stocks and bonds. Commodities can also provide a hedge against inflation, as commodity prices often rise with inflation. However, commodity prices can be highly volatile and are influenced by a wide range of factors, including supply and demand, weather patterns, and geopolitical events. Investing in commodities also does not provide any income, as commodities do not pay dividends or interest. There is a wide range of investment options available beyond the traditional stock market. Bonds offer a predictable stream of income and can provide stability to a portfolio. Mutual funds and annuities provide professional management and diversification, but also come with fees and potential limitations. Real estate and commodities offer unique diversification benefits, but also come with their own sets of risks and considerations. As with any investment, it is essential to thoroughly research and understand the specific investment vehicle, including reviewing the prospectus when applicable. Diversification across multiple asset classes can help to manage risk and optimize long-term returns.